Welcome back to Alpha Found, Part 8. If the multi-moment models don't give us the answer we are looking for, and multi-factor models are more descriptive than explanatory, there is only one place left to go to explain the volatility effect that has been taken seriously. In this case, it isn't one idea, but a collection of ideas. Those being that the assumptions of CAPM are not wholly valid. When more realistic assumptions are considered, the volatility effect appears as a natural consequence. Rather than dig through several articles to examine what happens when the assumptions are relaxed, I want to look at just one titled Explanations for the Volatility Effect, an overview based on the CAPM assumptions, by David Blitz, Eric Falkenstein, and Pim van Vliet. They do an excellent job, so it is much better just to go through what they have done rather than try to recreate it. Their goal is to organize the different possibilities according to which CAPM assumption it violates. My goal is to cover their work enough to give the flavor rather than dig up all the details. Some points are skipped altogether. They begin by citing Fama Macbeth and then Haugen and Hines, who concluded that the risk-return relationship is flatter than CAPM predicts. This is just another way of saying that positive alpha is associated with low CAPM beta. It means the security market line has a lesser slope than predicted. Then they cite Fama and French, who note that after adjusting for size effects, systematic risk and return are not connected, which means there is no security market line. Using size as an additional factor sends us back to multi-factor models. In some studies, the risk-return relationship is negative, meaning lower risk leads not just to higher alpha, but to higher absolute returns than that achieved by higher CAPM beta investments, which means the security market line slopes downward. These effects exist in international markets as well. Whatever is going on, it is persistent across time and markets. You can look up the article to get the citations. Blitz, Falkenstein, and Van Vliet organized the CAPM assumptions a little differently from Bodie, Kane, and Marcus, as listed in the fourth video, but the substance is the same. We're going to look in a superficial way. The first assumption they relax is no constraints on leverage, meaning an investor can borrow or sell short without limitation. In reality, there are constraints on both borrowing and short selling. As a consequence, to increase expected return, there is no place to go except higher CAPM beta securities, which have higher systematic risk. This increases the demand and therefore increases the price of those securities above fair value, which lowers alpha. This leaves low CAPM beta securities with higher alpha. With no short selling, the optimistic investors for each security become the owners, without offsetting downward price pressure that short sellers would provide. This distorts the risk-return payoff. For both of these violations of assumptions, it means investment managers are not completely rational with respect to asset pricing, but may be rational with respect to their personal financial compensation, which is often tied to relative investment performance. That is, analysts can see the overpriced state, but are forced by their inability to use leverage or short selling into buying higher CAPM beta stocks. Perhaps buying high-risk stocks is rational for an investment manager, but not rational for an outside observer who does not have the same pressures. According to the article, constraints on leverage filters into most of the other possible explanations for the volatility effect that arise from violations of the CAPM assumptions. Next, they look at investor utility, meaning an assessment of what the returns are from an investment in terms of utility rather than in dollars. The thinking goes like this. According to CAPM, investors are utility maximizers. In reality, investors are concerned with relative utility, not maximum utility. That is, most people want to do better than their neighbors, not necessarily better against an abstract standard. Utility maximizers are motivated by greed, whereas those concerned with relative utility are motivated by envy. This subtle difference has important implications. Relative utility may cause investment managers to seek higher risk investments, though their own analysis tells them it's not a great idea after adjusting for risk. Compensation of investment managers motivates risky behavior in that often managers are paid a bonus for outperformance, but no negative bonus for underperformance. The only reliable path to outperformance given the constraints of investment policy is to seek higher risk investments. This increases demand and therefore the price of high CAPM beta securities. There is no downside for the manager. As an example, investment managers attract clients based on relative performance. If the market is down 10% and clients of the investment manager are down 8%, the clients have lost an absolute value of 8% but gained 2% in relative performance. If markets are up 20% but the manager is up only 18%, the 2% relative underperformance hurts the manager's ability to attract business and may in fact lose business, though the clients had great absolute returns. CAPM assumes investors are mean variance optimizers. In reality, investors might have a preference for skewness. Preference for skewness distorts the construction of CAPM. It is a risk-seeking behavior that seeks out investments that have potential for outsized returns, thus pushing prices higher than their fair value, leading to lower alpha. This is more likely for high CAPM beta securities rather than low CAPM beta securities. The thought of outsized returns changes investor motivations. If investors are not risk-averse, then naturally the investment payoffs will reflect the higher prices paid for higher risk. The last set of explanations revolve around behavioral finance explanations. There is a rich literature on behavioral finance, to the point that Daniel Kahneman and Richard Thaler have been awarded Nobel Prizes for their work in 2002 and 2017, respectively. CAPM assumes investors are rational. In reality, investors make several cognitive and behavioral errors. The representativeness heuristic, mental accounting, overconfidence, among other cognitive and behavioral errors cause unintentional errors in the assessment of value. Specifically, investors can become blinded to the reality of risk, or having seen it, pursue it against their own better judgment. To talk this through a little, the representativeness heuristic says that people rely more on appealing anecdotes than on dull statistics. For example, when one stock that you perhaps haven't heard about is compared favorably to a stock you have heard about, or when a stock has some similar attributes to a stock or stocks that do well, the reputation of the stock or stocks you have heard about gets mentally transferred to the stock you have not heard about. For these stocks, the price is bid up too high. Another possibility is mental accounting. Many investors have a portion of their assets set aside for rational investing and another portion set aside for high-risk opportunities. This is similar to skewness preference, and also is similar to gambling behavior in that people will gamble with a maximum loss in mind, and will continue to gamble until that limit is reached. The rest of their money is not to be gambled with. The final behavioral explanation is overconfidence. Plenty of investors think they have above-average abilities and can take higher risk without the associated downside cost. These investors are optimistic, which is a good trait under most circumstances, but for investing, it results in risk-seeking behavior. Confident investors and market timers do not play in the low-risk end of the sandbox, which again means higher-risk stocks get more attention and higher prices than they deserve, hence the volatility effect. The paper reviewed here has more to it than this brief review would indicate. I find the reasons and reasoning to be compelling. However, it is frustratingly nonspecific. How much of which cause result in how much alpha for low CAPM beta securities? I suspect the authors would like to have the same information. There have been a large number of proposed explanations for the volatility effect, some of which I have not mentioned. The problem feels unresolved in an annoying kind of way. The next two videos set the table, then we begin looking at the new model.